Meanwhile, investors have been weighing the potential disruptions posed by rapid advances in AI, recently knocking shares of software companies. So let's get some perspective on how to approach investing amid uncertainty over AI and the economy. Joining us now is Chris Kampitsis, a managing partner at Barnum Financial Group. It's good to have you join us. Chris, thanks so much.
Of course, wonderful to be here.
So, I mean, a lot of people have made some pretty big investments in AI over the last couple of years, possibly making a lot of money investing in AI. As we look ahead into 2026, though, what should investors be thinking when they're investing into AI?
Yeah, we look at it as what had been for a long time the promise of AI has now evolved. And it's about showing results and seeing the impact of artificial intelligence. And where we see the best opportunity is in businesses that are unrelated typically to technology, et cetera, but incorporating AI to increase profit margins, to reduce costs. That's what 2026 and beyond is all about from an AI and technology perspective from our vantage point.
When it comes to fears over AI disruption, what are you telling investors on that front?
We think the fears are largely exaggerated. I mean, it makes sense when there's a new technology on the horizon, when there's this new quote unquote perceived threat, people are always going to assume the worst case scenarios. We saw this with software stocks. We saw this with financials recently. But the reality is, truth ends up typically being somewhere in the middle. It's about how companies can incorporate artificial intelligence to improve their business and improve ultimately the customer experience. That's what's going to continue to drive the market higher. That's what's going to drive stocks higher over the long term.
When it comes to some of the big tech stocks, right? Like we saw such a run throughout 2025. Should investors be kind of tempering their expectations heading into 2026? Obviously, we're in 2026 already, but maybe not expecting a run that we saw in 2025?
Yeah, I think that's really fair. And that's okay. Sometimes certain sectors, certain stocks, it can get a little bit over their skis. They can get expensive. We recommend taking a barbell approach. Don't run and hide. Don't stop owning the Mag 7 stocks, but to expect the same level of return that you saw from them over the next 3 years, that you saw over the last 3, 5, and 10, that's probably a little bit unrealistic.
Okay, so taking a look at the markets now, if there's certain sectors that you think that you like, which sectors are you kind of watching for?
Yeah, so we do like the technology and growth story. We want to incorporate that in our portfolio, but we also want to look for areas of opportunity in terms of valuation. So we've been big proponents for a while now on consumer staples, utilities, thinking a little more internationally, getting involved in emerging markets. Those trades have worked out well for us. We think those themes will continue going forward well into 2026 and beyond. And listen, the reality is, with everything happening geopolitically, with valuations, basically the market price to perfection, every year it's practically an annual tradition. The market pulls back 10% at some point in time. And so we want to have cash on the sidelines here. If we're going to get into these expensive growth names, if we're going to be buying Mag 7, well, maybe you want to purchase that at a better price at some point in the not too distant future. We're confident, unfortunately, at some point there will be better prices to be had.
Oh, you mentioned emerging markets, international markets. Is that where you think investors really should be looking in the years ahead instead of looking at U.S. markets? And if so, are there certain sectors overseas that you think are doing better?
Yeah, well, when you're investing in emerging markets right now, it in essence is an extension of the AI trade. Right? You have companies like Taiwan Semiconductor, et cetera, where you're getting high growth technology, semiconductor type of exposure, but the currency story is improved. What we're seeing is the dollar is weakening. If we get 3 more rate cuts this year, there is a case that could be made that the dollar weakens up to another 10%, right? And we don't know exactly what that'll be, but when we're investing internationally and into emerging markets specifically, that tends to be a favorable trade.
Okay, we will leave it there. Chris Kampitsis, managing partner at Barnum Financial Group. Appreciate your time and your insight. Thanks for joining us.
Thanks so much.